If you think keeping a large amount of money in your bank account is always the safest move, there's one detail in 2026 you do not want to ignore. Because it's not just about how much money you have. It's about when that money moves, where it came from, how it's reported, and whether your records match what the IRS can already see. And that is exactly where a lot of people get into trouble. Not because they robbed a bank, not because they were trying to hide millions, but because they assumed, it's my money, it's in my account, so there's nothing to worry about. That assumption can become very expensive. The truth is, there is no law that says simply having a certain amount of money sitting in your bank account is illegal. Let's clear that up right away. The problem is not usually the balance by itself. The problem is visibility. In 2026, banks, payment processors, and financial institutions continue to report certain activity, certain interest income, certain cash transactions, and suspicious patterns. And if your tax return, your explanations, or your paper trail do not line up, that's when the IRS starts asking questions. But here's what most people don't realize. A lot of financial trouble begins with ordinary behavior. A deposit here, a transfer there, cash from a home sale, a car sale, side work, a family repayment, maybe money you've been saving for years. To you, it may seem simple. To the reporting system, it can look very different if it is not documented properly. So if you've been thinking, how much money is too much to keep in my bank account? The better question is this: can I clearly explain where the money came from? And does that explanation match what gets reported? That next detail changes everything. Many people hear rumors online that if you keep more than $10,000 in your account, the IRS automatically comes after you. That is not how it works. There is no magic rule saying your account balance crosses one line and suddenly you are in trouble. What often gets confused is the reporting of cash transactions. When a bank receives more than $10,000 in cash in certain situations, it may file a currency transaction report. That report is not the same thing as an accusation. It is simply part of the reporting system. But do not overlook this part. The real mistake some people make is trying to avoid that report. They may break up deposits into smaller amounts, thinking that keeps them under the radar. That can create a much bigger problem. Why? Because breaking transactions into smaller pieces to avoid reporting can look like structuring, and that is exactly the kind of pattern banks are trained to notice. So imagine this: you sell a vehicle for cash, or maybe you have money saved at home from years of withdrawals, gifts, or older business income. Then you start depositing it in small chunks because a friend told you, just keep it under 10,000 and you'll be fine. That advice can backfire badly. Instead of one large transaction with a clean explanation, you now have a suspicious pattern. And suspicious patterns can trigger bank review, account restrictions, or even reports that raise more concern than the original deposit would have raised. There's something even more important than the deposit amount itself. It's documentation. If you cannot show where the money came from, when you received it, why you received it, and whether it was taxable, you leave yourself exposed. And the larger the amount, the more important that explanation becomes. Let's say you sold property, received an inheritance, got insurance proceeds, withdrew money from another account, or moved funds after a divorce settlement. Those situations can involve large amounts of money, but they are not all treated the same for tax purposes. Some are taxable, some are not. Some are partly taxable, some were already taxed in a previous year. If you mix everything together without records, what should have been easy to explain becomes confusing fast. And confusion is expensive when the IRS gets involved. Before you assume this only matters to wealthy people, it doesn't. Seniors are often affected because they may receive lump sums, inheritances, retirement distributions, home sale proceeds, or family transfers. Some people help children. Some people receive help from children. Some move money between checking, savings, brokerage accounts, and certificates of deposit. Some cash out part of a retirement account for home repairs, medical costs, or emergency care. None of that automatically means you did anything wrong. But if the reporting forms show income, interest, distributions, or large movements of cash, and your tax return does not reflect those items correctly, the mismatch can create a problem. We'll come back to one common mistake in just a moment because it catches more people than you might think. First, let's talk about what the IRS often sees without you realizing it. Banks can issue forms that report interest income, brokerages report dividends, capital gains, and certain account activity. Retirement account custodians report distributions from IRAs, pensions, and other qualified plans. Payment platforms may issue information returns depending on the type of payments involved and the applicable rules. Mortgage lenders, escrow companies, and other institutions also generate records. So even if you never tell the IRS directly, a lot of financial information reaches the system through third-party reporting. That means the old idea that if I don't mention it, nobody will know is one of the most dangerous financial beliefs a person can have. Here's a simple example. Suppose you keep a very large amount of money in a savings account because you are afraid of the stock market. That account earns interest, maybe not a huge amount, but enough to generate a tax form. If you forget to report the interest, the IRS computer may notice because the bank already reported it. Now that issue may be small at first, but small mistakes add up, especially if they happen year after year or across multiple accounts. And here's the part many people miss. The larger your cash holdings, the more likely you are to generate visible activity over time, even if the balance itself is not the direct problem. Interest, transfers, cash deposits, withdrawals, account changes, linked accounts, all of that creates a trail. That trail is not something to fear if your records are clean, but if your records are messy, it becomes a headache fast. Now let's go back to that common mistake. A lot of people confuse not taxable with not reportable or not worth documenting. Those are not the same thing. For example, receiving money from a family member may not always create income tax for the person receiving it. But if large sums are moving around and later questioned, you still want records showing what the transfer was. Was it a gift, a loan, repayment, shared property proceeds, help with housing, medical support? If no paperwork exists, people often start giving different explanations later, and that is when problems grow. Let's say your daughter sends you $20,000 to help you buy a safer car. You put it in the bank. If anyone ever asks, you want a clear answer, and ideally a written record showing it was family support or a gift, not self-employment income, not rent, not hidden business revenue. That distinction matters. And there is another issue that people ignore at their own risk. Cash is treated differently from electronic transfers in some situations. If you move money from one account you already own into another account you already own, that is usually much easier to explain than a pile of unexplained cash deposits. Cash creates more questions because it is harder to trace. Where did it come from? When was it earned? Was it already taxed? Was it from a legal source? Was it part of a business? Was it split into smaller deposits? That does not mean cash is illegal. It means cash requires cleaner explanations. Have you ever heard someone say, "Just keep your money under the mattress and put it in the bank little by little"? That may sound smart to some people. In reality, it can create exactly the kind of pattern banks do not like. And this next detail is critical. Banks are not only looking at one transaction, they look at patterns. Repeated, unusual cash deposits, sudden changes in account behavior, transactions that do not fit the customer's normal profile, frequent transfers with unclear purpose, activity that seems inconsistent with the person's known income or history. When a pattern looks unusual, banks may file a suspicious activity report. Again, that does not mean guilt, but it does mean the activity drew attention for a reason. Now let's make this practical. What should people actually avoid in 2026? First, avoid making up explanations after the fact. If money came from a sale, keep the bill of sale. If it came from an inheritance, keep the estate paperwork. If it came from a gift, keep written proof. If it came from your own old savings, keep whatever records you have showing where those funds originally came from. Second, avoid breaking up deposits for the purpose of staying under reporting thresholds. That strategy can look worse than a single honest deposit. Third, avoid forgetting taxable income just because it sat in your account for months before you used it. The timing of when you spend money is not what decides whether it was taxable. Fourth, avoid mixing business money and personal money if you do any kind of side work. That is one of the fastest ways to create confusion. If you sell items, do freelance work, help people for cash, or receive payments outside a formal paycheck, keep good records. Even small side income can become a problem if it is inconsistent with what gets reported elsewhere. Fifth, avoid assuming the IRS only cares about rich people. That is a very costly myth. Most tax notices start with mismatches, missing forms, math errors, or unexplained items. Those things can happen to anyone. But here's where many viewers feel relief. You do not need to panic just because you have money in the bank. If the funds are legitimate, your taxes are handled correctly, and your records make sense, having savings is not a crime. In fact, for many seniors and retirees, keeping a healthy cash reserve is financially reasonable for emergencies, home repairs, insurance deductibles, travel, or market uncertainty. The issue is not too much money. The issue is money you cannot clearly explain. That is the line people should remember. Let's take another real-world type of situation. Suppose you recently sold your home, downsized, and parked a large amount of cash in the bank while deciding what to do next. That may be perfectly normal, but the paperwork from that sale matters. The settlement statement matters. Any tax documents connected to the sale matter. Why? Because if questions come later, you do not want to rely on memory alone. Or imagine you withdrew a large amount from retirement savings. Maybe you needed funds for a major expense. That money was not invisible just because it moved into checking. Retirement distributions are often reported. If taxes were withheld, that should line up. If no taxes were withheld, you may still owe, depending on the situation. The bank balance is not the main issue. The source and reporting are. Don't overlook this part either. Even legal money can become stressful if your record keeping is poor. People often think trouble only comes from fraud, but very often the trouble comes from sloppiness, missing forms, no receipts, no written explanations, no separation between transfer, gift, income, and sale proceeds. And once time passes, details get fuzzy. So what should viewers do right now if they are worried? Start by reviewing large deposits from the past year or two. Can you explain each one clearly? Do you have documents? Do the documents match the amount? Was any of it taxable? Was any form issued to you? Did you report all required interest and income on your return? Next, look at any cash activity honestly. If you have large amounts of cash sitting around, ask yourself whether you can document where it came from. If you need to deposit it, do not play games. Be truthful. Be consistent. Keep records. Then, review any side income, online sales, consulting, repair work, or informal jobs. A lot of people underreport this because they think it is small. But when payment records, bank activity, and tax returns do not line up, that is when small issues turn into notices. And if you are handling something unusual, like a very large transfer, a settlement, property proceeds, estate money, or years of saved cash, it may be worth speaking with a qualified tax professional before making moves that create confusion. That one step can save you a lot of stress. There is one more point many people need to hear. The safest financial behavior is not secrecy. It is clarity. Trying to stay invisible often causes more trouble than simply handling things correctly from the start. Clean records, honest reporting, consistent explanations. That is what protects you. So if you came into this video thinking the IRS is just watching for a certain bank balance in 2026, the real answer is more nuanced than that. It is not about one number sitting in your account. It is about whether your financial activity makes sense, whether required information is being reported, and whether you can support your story with documents if questions ever come up. That should reassure honest people. At the same time, it should be a wake-up call for anyone relying on rumors, shortcuts, or cash myths from social media, because those shortcuts can cost you far more than they save. The bottom line is simple. Never keep money in your bank account that you cannot explain. Never move money in ways that look like you are trying to hide it. Never ignore the tax forms connected to your accounts, and never assume that a quiet account means invisible money. In 2026, the smartest move is not fear, it is preparation. Know where your money came from, know what was taxable, know what was reported, and keep records before you need them. If you do that, you put yourself in a much stronger position, no matter how much money is in the bank. If this helped clear things up, make sure to like the video, subscribe, and turn on notifications so you do not miss important updates that could affect your money, your records, and your peace of mind. And if you've ever dealt with a confusing deposit, tax form, or bank question, let us know in the comments.